Today, I'll be speaking with Gabriel Zucman, who's an internationally renowned economist, best-selling author of We Need to Tax Billionaires, and also one of the architects of the California Billionaire Tax Initiative. Great to talk to you. Really appreciate you being here today.
Thanks for having me.
I'm very interested in this topic because it seems as though many people, not all, but many people agree we need to do a better job of capturing tax money from the wealthiest of the wealthy. But there is some disagreement as to the best way to do it. So, for example, you raise the income tax rate. The super wealthy don't earn income, so it doesn't really make a difference to them. So then you say, well, let's raise the tax on capital gains and make it higher or equivalent to income taxes. But capital gains taxes come into play when gains are realized. And so if you hold assets at a gain but don't sell and borrow against them, well, then the capital gains rate doesn't really affect you. So then sometimes we get to a wealth tax, and then you hear about, well, it's hard to value a lot of the assets and people will leave the state or the country. There's capital flight, etc. So let's start at the 40,000 foot level. What does data tell us about the most effective way to tax billionaires?
The most important thing to understand is that the income tax is just not the right tool to tax the extremely rich. The income tax, the progressive income tax, uh, is a big revolution of the beginning of the 20th century. A number of states started creating their income taxes, and then it became federal policy in 1913 with the federal income tax. And it's been hugely important. It's the pillar of modern tax systems. It is what has allowed governments to expand, to fund education, infrastructure, healthcare in part. So it's been extremely important, but it's an unfinished revolution because the ultra wealthy are still not in the system,
Right.
so to speak. And the reason for that is that when you're extremely rich, it's very easy to structure your wealth such that this wealth will not generate any income or any significant amount of taxable income. And for instance, a few years ago, you had revelations by ProPublica on the taxes paid by US billionaires, and you saw people like Elon Musk or Jeff Bezos paying very little income tax. There's even one year when Bezos says, look, I'm so poor that I'm going to claim the child tax credit. And he receives the child tax credit.
Right.
And there is nothing illegal in that. It's not tax evasion. It's the way the system works. If you manage to look like you're poor from the perspective of the tax law, well, you're not going to have any income tax to pay. And that's exactly what he did as CEO of Amazon. He didn't pay himself a wage. Amazon didn't distribute dividends, so he didn't have to pay taxes on dividend income.
Right.
And he didn't sell shares, and so he didn't realize capital gains, and so he paid no capital gains tax. So he really looked like a poor person from the perspective of the tax law, the income tax law, even though he's one of the wealthiest person in the world. And so once you've understood this, you've understood that the proper way to tax the super rich, like Bezos, is not with the income tax, but is with some form of tax that's based on wealth, because income is very easy to manipulate when you're extremely rich, but wealth is much harder to manipulate.
Okay, couple questions on wealth taxes. When we talk about wealth, are we talking only about assets or assets and liabilities? And the reason I ask that is even if we get beyond we only tax realized gains. Well, the point of the wealth tax is also to include unrealized gains. If someone takes a big loan against their assets, that's a liability. So I could have a billion in assets and a loan for $1 billion, and I go, I have no wealth. So how do we deal with that?
So wealth is the total value of all the assets that you own, real estate, but mostly for rich people, financial assets, equity, shares in companies, and so on, net of any debt. Now, to your concern about, okay, those rich guys are going to avoid a wealth tax by borrowing money, I don't think that's an issue because if you borrow money, well, you go to the bank, you borrow $1 billion, okay, but now you have $1 billion in assets on your bank account. So your net wealth has not changed at all.
Okay.
Of course, if you consume that $1 billion, then okay, your wealth goes down, but you are getting poorer. So that's okay. But what I want to emphasize is that borrowing money does not mechanically reduce your wealth.
Let's talk about where wealth taxes have been implemented more versus less successfully, maybe. So I'll give you my understanding, and maybe we agree on it, maybe we don't, but we'll start there. It seems as though Switzerland has relatively successfully implemented a wealth tax, and Norway has successfully implemented a wealth tax on the one hand. I've also read that France and Sweden were not successful in the same way on those implementations. Is my understanding even correct, first of all? And
I
then can
think
you distinguish between the structures here?
it's a fair summary that the two best functioning wealth taxes today in the world are those of Switzerland and Norway.
Okay.
That's fair. And I think, I'd go even further than you. I think the historical and the international experience with wealth taxation, by and large, is not a success. Is a pretty big failure. In fact, France is a good example, but Germany, Sweden, Denmark, Spain all used to have wealth taxes and they didn't work well. Now, you can look at that history and that experience in two ways. You can say, okay, some countries have tried to tax wealth, it didn't work very well, hence it will never work. End of story. Or you can look at it and you can say, okay, what were the problems? Can we learn from that history? And can we draw some lessons? And can we do better in the future?
Yeah.
The reality is that, of course, we can do much better because the problems that existed in countries like France, they have solutions. So, most importantly, in France, like in many European countries, the wealth taxes that existed, they exempted the billionaires. The law was written in such a way that if you owned a lot of shares in a company, in France, more than 25% of the shares of the company, all that wealth was excluded from the base of the wealth tax. And look, the wealth of billionaires, it's exactly this. It's owning a lot of shares in big companies. So, of course, don't write the law like that. If you create a wealth tax, it should be first and foremost on the super rich, so don't exempt their wealth. And Prop 40 in California, the California billionaire tax, is written exactly like that. So in contrast to past wealth taxes, to European wealth taxes, it is only on the super rich, just on the billionaires. If you have less than $1 billion, you're not affected, but with no exemption whatsoever. If you have more than $1 billion, you will have to pay 5% one off, one time on all of your wealth.
What system is necessary? This is a question about bureaucracy. It's sort of a very, nitty gritty question. If you include art and private equity, tech startups, non public assets, to what degree do you need to get experts to accurately value all of those assets for the calculation? Does the government now need to have experts in fine art go and look at people's art storage and talk about the bureaucracy a little bit?
Yeah. Fortunately, it would be much easier than that. So, number one, more than half of the wealth of billionaires corresponds to shares in publicly listed companies, listed on the stock market. Very
Half.
easy to
Okay, more than
observe,
half.
very easy to value.
Yep.
Number two, most of the rest, almost all the remainder, is shares in big private companies, not listed on the stock market, but because they are big companies, it's relatively easy to value them. You look at how similar companies that are listed on the stock market are valued by the stock market. The way it would be done in California with Prop 40 is that the valuation would be done by private assessors. So billionaires would have to obtain a certified valuation for their private businesses, and that would serve as the base of the wealth tax. And there would be penalties for undervaluation or overvaluation. All of that has been written very carefully by the best legal experts of the US. So the government wouldn't have to do it, right? The private sector and the taxpayers themselves, hiring assessors would have to do it. Now, sometimes there is a view that, oh, a lot of the wealth of billionaires is things like art.
Yeah.
What about the Picassos, and the yachts? And look, those things exist, sure. But first, it's a very small fraction of the wealth of billionaires. And two, even those forms of wealth are relatively easy to value because if you own a Picasso, I'm sure that's your case, then there is an insurance value. It's insured, right? And so there's an
Yes.
insurance value that you can use for the purpose of the wealth tax.
Let me propose a sort of different framework. And just to be clear, so my audience knows and you knows, I'm in favor of wealth taxes. I think that they're great ideas morally and ethically. We're just kind of trying to pressure test some of this stuff and figure out, is this really the best approach? From what I've read, Prop 40, even as written, legally would be dubious in a number of ways. And what I mean by that is not that you and I are going to litigate it here, but just that it would be subject to litigation that could take years and no money ends up getting collected. There's a bunch of different reasons. Let me propose an alternative and you tell me, isn't this simpler? And we make a couple other different changes. Number one, and the goal is let's get money from the very wealthiest people. We end stepped up basis. This is number one. Over a period of time, this will allow the collection of additional tax revenue. We do raise capital gains rates. And also, if you borrow against assets, that triggers capital gains as if you had sold it. Okay, so that's number two. We close a few tax loopholes like carried interest and dynasty trusts and offshore shelters. So I'm kind of throwing a bunch of different smaller things, but all of which have a legal path that is much clearer than it putting in place a wealth tax. Good idea, bad idea? What do you think?
I think these are good ideas that we should do all the things that you just mentioned,
Yeah.
but it's not an either or issue. It's not like if we do these necessary fixes to the income tax, then we don't have to do a wealth tax.
Mm,
We should do both.
do all of it, you're saying.
All of them, right? Because it's for sure it's a good idea to close the step up in basis loophole that allows people to erase any capital gains tax liability when
Yeah.
they die. So let's fix that. Great. But the deeper problem is that when you're a billionaire, you don't have to realize capital gains, neither today, nor tomorrow, nor in 10 years, nor in 30 years. Even your children, they are going to inherit billions in wealth. They don't need to sell those shares. And so there's
Well,
just
wouldn't the stepped up basis issue deal with that at the time of death anyway?
it depends how you do it. So if you say that when people die, then they have death is a realization event, so they have to pay capital gains
Ah,
tax
right.
at the
Okay.
time of death. In that case, yeah, they will have to pay when they die. The way some countries operate is that there is a so-called carryover of basis. I'm sorry, it's a bit technical, meaning heirs inherit the basis of their
Right.
parents. In any case, long story short, you do those fixes, and in the best case, you get money, the government gets money when billionaires die.
Yes.
But that can be decades. In most cases, it's going to be decades down the road.
Yep.
And here there is something that's really weird because for most people, almost everybody has to pay taxes each and every year. If you're self-employed, you have to make advanced tax payments each quarter. The government really insists on you paying taxes on a very regular basis. And that's for good reason. It's because we have collective revenue needs for education, for health, for infrastructure. And so we can't wait for 20 or 30 years before the government gets money. It needs money every quarter, every year. Why should the billionaires be allowed to pay in decades down the road when
Right.
everybody has to pay now? That's the fundamental problem. Um, and if you do what you described, which is just to say, okay, when people borrow money, they will have to pay taxes on that borrowing. Fine, do it. But these are small amounts. It's important to understand that the billionaires, it's not like they're borrowing a ton of money. They only need to borrow money to fund their own personal consumption expenditures.
Right.
But that consumption is just very low relative to their true income or relative to their wealth.
Yeah,
Because
it
when
actually seems like that would apply more to people with between 20 and $50 million
true,
than as a percentage of their assets than billionaires.
good point. Exactly. For billionaires, it's just not quantitatively relevant.
Yeah.
And last thing, I just want to push back on this widely held view that somehow there's going to be a lot of litigation with the California billionaire tax. It's very complicated. Sure, that's what the billionaires say. Look, they want to defend the status quo. The current situation is great for them,
Yep.
and they're making all sorts of threats. The reality is that we're talking about 250 taxpayers.
Yep.
Their wealth, very simple, in most cases, to value, to observe. They would have to pay first. They can sue, they can try to litigate, but the way the text is written is first you have to pay. And this type of argument that, oh, it's a new tax, it's going to be complicated, is exactly the type of arguments that people were making at the beginning of the 20th century when there were debates about the creation of the income tax.
Hmm.
The opponents, their main argument was, oh, but income is just very complicated to measure because what's an allowed expense? What counts as revenue? We don't know. It's going to be a mess.
No,
And,
that's
you
fair, but
know,
let me interject briefly. I think my instinct is that the legal problems, the most likely legal problems would be the following ones. I think although the retroactivity is smart so that if someone leaves, it actually goes back to January 1st. I think that's smart, but I think there's an argument that that violates due process under the US Constitution, which I'm not going to litigate it now. I think that could be a years long issue. Two, if someone leaves in the midst of the year and then they go, well, I was there for 2 of the 12 months, and then I don't know, I think that that's potentially an issue, and then the other one I think is potentially an issue. And if you have thoughts on these, I'd love to hear them too. The taxation of worldwide assets. I just don't know how California tax assets sitting in Europe that have never been in the United States legally under the current law. I'm just not sure. I would love it if you had, clear answers to this and you go, David, don't worry, that's not going to be a problem.
it's not going to be a problem.
Okay, good.
The income tax in California is
Yep.
already a tax on your worldwide income. Okay, so if you live in California and you have assets abroad, you have
Yep.
shares in foreign companies, and they generate dividends and capital gains, all of that is taxable in California.
But by convention with those other countries, right? That's the difference.
Say that again?
The other countries are part of an agreement that that will be done and to evade double taxation. So that's sort of like we've come together to everybody agrees that that's what we're doing.
Oh,
In this
sure. I
case,
mean,
yeah, I mean, I don't know.
the way it works is that if you've already paid tax on that income
Yep,
abroad, you can credit those
exactly.
taxes against the California and the federal income tax.
Right.
Now, if some countries also want to tax the wealth of billionaires and their wealth abroad, that would be creditable against the California wealth tax. Now, it turns out that no country taxes billionaire wealth, the wealth of California
Right.
billionaires abroad. So that's a non-issue. But what I want to say is that the idea that conceptually it's difficult to tax foreign wealth
Mm-hmm.
is wrong because we already tax foreign
Absolutely.
income that derives from owning foreign assets. So that's number one. Number two, under small retroactivity. So this is actually a brilliant idea. So the way the text is written is it says if you are a billionaire and you were a resident of California as of January 1st of 2026,
Right.
then you have to pay the 5% one-time wealth tax, meaning it's too late for billionaires to move and avoid the tax.
Exactly.
The constitutional experts, the legal scholars who've been extensively consulted for crafting the text of Prop 40 are adamant that this is valid, this
Mm-hmm.
is compatible with US law, California, and federal law. I'm not a constitutional, lawyer, but I'm relying on those
Of course.
best minds. And the reason why it's beautiful is that it really removes any risk of uh, rich people fleeing, moving to another state to avoid the wealth tax. They can't do it. The initiative was announced in November of 2025. So they just had a few weeks at the very end of 2025 to move out of California and cut ties with California.
Right.
And what the experts in this area of law think, California tax law they believe that no billionaire was able to successfully cut ties from a tax perspective with California in such a short period of time. Because if you
Yep.
want to become a non-resident, you have to change doctors, you have to change schools for your children, you have to
Where's your veterinarian?
pay
This
your
sort of
debt,
stuff. Yeah.
everything. And in just a few weeks in December, it's very unlikely that a single billionaire was able
Yeah.
to do it effectively.
Well, listen, you've made a very strong case that this is much more bulletproof, at least than some of the detractors claim. And I know many in my audience, myself included, are pleased to hear that. We've been talking with Gabriel Zucman, economist, author of We Need to Tax Billionaires, also one of the architects of the California Billionaire Tax Initiative. Really appreciate your time today. Thank you so much.
Thanks for having me. Great pleasure.